There is a conversation that happens at almost every family gathering once someone finds out you are interested in personal finance. Someone pulls you aside, usually an uncle or a coworker's husband, and they want to know what you think about their money. And somewhere in that conversation, they say something like, I have got it all in bonds because I am retired and bonds are safe. Or the other version, I do not bother with bonds at all, I just buy dividend stocks because at least those pay me something. And both of those people are working from a half-truth. Bonds are not simply safe, and dividend stocks are not simply better. They are two completely different tools built for two completely different jobs, and putting all your money in either one without understanding what you are actually doing is how perfectly good retirement savings ends up working a lot harder than it needs to. If you have money to put to work and you are trying to figure out whether bonds or dividend stocks deserve it, this video is going to give you a real answer based on what actually matters for your specific situation. Let's break this down properly. First, let's make sure we understand what each of these things actually is, because the words get thrown around constantly and the definitions matter more than most people realize. A bond is essentially a loan you make to a government or a corporation. You hand them money, they promise to pay you a fixed interest rate on a regular schedule, and they promise to return your original amount at the end of the bond's term. The safety of a bond depends entirely on the creditworthiness of whoever you are lending to. A United States Treasury bond is about as close to guaranteed as anything in investing gets because the U.S. government has never defaulted on its debt. A corporate bond from a shaky company is a completely different animal. The interest rate is higher because the risk is higher, and if that company goes under, your money can go with it. So when people say bonds are safe, what they usually mean is high-quality government bonds are safe. Not all bonds. The category is wider and more varied than the reputation suggests. Right now in 2026, a 10-year U.S. Treasury bond is yielding around 4.7% annually, and the 30-year Treasury is sitting around 5.3%. Those are genuinely meaningful numbers. For context, just a few years ago, those same Treasuries were yielding closer to 1 and 2%. The bond market has changed significantly, and the income you can get from high-quality government bonds today is real in a way it simply was not for most of the last decade. A dividend stock is a share of ownership in a company that has committed to paying shareholders a portion of its profits on a regular basis, usually quarterly. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, utilities companies, real estate investment trusts, these are the classic dividend payers. They tend to be established, stable businesses that generate consistent cash flow and return some of that cash to shareholders as dividends. The income feels similar to bond interest on the surface because both show up in your account on a regular schedule. But the underlying mechanics are completely different, and those differences matter enormously depending on what you are trying to do with the money. Let's talk about income first, because for retirees especially, this is usually the primary concern. Bonds pay a fixed rate. If you buy a 10-year Treasury, paying 4.7% today, you know exactly what you are getting every 6 months for the next 10 years. There is no surprise, no upside, no variability. 4.7% is the whole income story for that bond. Dividend stocks pay a variable income. The yield might look attractive today, but the company can cut or eliminate the dividend if business conditions change. On the other hand, dividend stocks can also raise their dividends over time, and the best dividend payers have track records of doing exactly that, increasing their payouts every single year for decades. There is a group of companies called dividend aristocrats, currently 69 of them in the S&P 500, that have raised their dividend every single year for at least 25 consecutive years. The average dividend yield across those 69 companies right now is around 2.5%, which sounds lower than a bond yield at first glance. But here is the difference that matters. That yield grew by around 4.1% on average in 2026 alone. A bond paying 4.7% pays the same 4.7% 10 years from now. A dividend growing at 4% annually doubles its payout in roughly 18 years. The income from quality dividend stocks is not fixed. It compounds. And that compounding is what makes it fight inflation in a way a fixed bond payment simply cannot. That brings us to the inflation question, and this is where bonds get their reputation dented a little when you look at the full picture. A bond's fixed payment does not grow. If inflation runs at 3% per year and your bond pays 4.7%, your real return after inflation is around 1.7%. Not terrible, but not impressive either. And if inflation spikes higher the way it did a few years back, a fixed bond payment suddenly looks a lot less attractive compared to what prices are doing in the real world. The bond itself also loses market value when interest rates rise because new bonds being issued at higher rates make your older lower rate bond less desirable to anyone who might want to buy it from you. This is the piece that surprised a lot of retirees in 2022 when they watched their supposedly safe bond holdings drop meaningfully in value precisely because interest rates were rising rapidly. Bonds are not as simple as safe. They carry their own specific risks that are just different from stock risks rather than smaller. Dividend stocks, on the other hand, participate in the growth of the underlying business. When a company raises its dividend because earnings grew, your income grew too. The stock price also tends to appreciate over time if the business is healthy, which means your principal is not just sitting flat the way a bond's face value sits flat. You are getting paid, and the value of what you own is potentially growing simultaneously. The trade-off is volatility. Dividend stocks can and do fall in price during market downturns. In 2022, when the market dropped sharply, plenty of dividend stocks fell 30 to 40% in value in a matter of weeks, even though many of them kept paying their dividends throughout. That kind of short-term volatility is genuinely uncomfortable, and for retirees who need to maintain confidence in their financial picture, it is not a trivial concern. There is also a tax consideration that does not come up enough in these conversations. Qualified dividends from stocks are taxed at the long-term capital gains rate, which for most retirees is 15% or lower, and for some retirees in the lower income brackets, it is zero. Bond interest, on the other hand, is typically taxed as ordinary income at your regular marginal rate. So a retiree in the 22% bracket is paying 22% on bond interest and potentially 0 or 15% on qualified dividend income. That difference in tax treatment can quietly add up to a meaningful amount of additional after-tax income over a retirement, even before you consider the underlying returns of each investment. So how do you actually think about which one belongs in your portfolio and in what proportion? The answer almost always comes down to three things: your time horizon, your income needs, and your ability to handle volatility without making a bad decision under pressure. If you have money you need to protect and access within the next 2 to 5 years, high-quality bonds or bond funds make more sense than dividend stocks. The price of a high-quality short-term treasury does not move around dramatically, and you can count on getting your money back at the end of the term. Using bonds for the portion of your portfolio that needs to be stable and accessible is exactly what they are designed for. This is the classic bucket strategy that a lot of retirement planners use. Short-term needs go in bonds and cash. Long-term money goes in stocks, including dividend payers. The bond bucket is not trying to grow your wealth. It is trying to protect your near-term spending money from market volatility. If you have money you do not need to touch for 7 to 10 years or longer, dividend stocks from high-quality established companies have historically delivered meaningfully better total returns than bonds over that time frame, while also providing growing income that at least partially keeps pace with inflation. The volatility is real, but over a long enough time frame, it tends to be noise rather than signal. The retirees who got into trouble with stocks were usually the ones who needed the money sooner than they planned and were forced to sell during a downturn rather than waiting for the recovery. Now here is the honest answer to the question in the title, and it is not the dramatic either-or people expect. For most retirees, the right answer is both, in proportions that reflect your actual timeline, your actual income needs, and your actual ability to watch a number go down temporarily without panic selling at the wrong moment. Someone who is 65 with a 30-year retirement ahead and puts everything in bonds because they feel safer is almost certainly leaving meaningful wealth and income growth on the table over a retirement that long. Someone who puts everything in dividend stocks and has no stable reserve for the years the market decides to test them is carrying more risk than necessary and may be forced to sell at the worst possible time to cover living expenses. A reasonable starting point that many financial planners use is to think about your guaranteed income first. If your Social Security and any pension you have already covers your essential monthly expenses, your portfolio does not need to take as much risk at all because it is supplemental rather than essential. In that situation, you can afford to hold more in dividend stocks for the long-term growth. If your portfolio needs to generate the bulk of your living income, keeping more of it in stable bonds and cash, enough to cover 1 to 2 years of expenses, gives you the buffer to ride out market downturns without being forced to sell equities at the worst moment. Bonds and dividend stocks are not opposites competing for the same job. They are teammates with different roles, and a retirement portfolio that understands the difference between those roles tends to be more resilient, more tax efficient, and more capable of lasting the full distance than one built around a single idea of what safe or smart is supposed to look like. The bond market is offering real income right now at yields not seen in over a decade. The best dividend stocks are offering growing income and long-term appreciation that bonds structurally cannot match. Using both deliberately is not a compromise. It is the whole strategy. If this helped you think about your own allocation with a little more clarity, share it with someone wrestling with the same question and hit subscribe while you are there, because we are still a small channel working toward our first 1,000, and every single person who joins genuinely matters. Thank you for watching all the way through. The next video is right there on your screen, and I will see you there.